Hello. Hello and welcome to the unofficial main event of FMLS21. The unofficial one dubbed by myself and my mother, and I'm absolutely delighted to have a stellar panel with me today. I'd like to, if you could introduce yourselves, your position, your company, and which side of the fence on the M&As you are.
Hello, my name is Daniela Egli. I'm one of the board members and the head of compliance for Fxview. We are a financial services company regulated by GCEX in Cyprus. We are also part of a bigger group of companies that has exposures to financial services, technology, real estate, and healthcare. I've been usually on the hunter fence, so I have some exposure to acquisitions on the buyer side.
Hello, my name is Andrey. I'm the co-founder of Prytek Group. So Prytek Group, it's a vertically integrated supply chain of different solutions in several industries. One of them is banking, education, HR, and cyber. But the focus is currently on the banking industry. I'm basically building what is the vertical integrated supply chains. We're building basically from technologies to the managed services in place for capital market industries. It's meaning for the capital market division of the banks or brokers. That's it.
Hi, my name is Luca Merolla. I'm a co-founder and managing partner of Guru Capital. Guru Capital is a private equity firm specialized in financial services and fintech acquisition. So we are hunting. We have acquired ETX Capital last year and Oval Money the beginning of the I think June this year. So I'm also on the board of ETX Capital UK and ETX Capital Europe.
My name is Lars. I have been hunted because I've been selling 2 companies. Most recently, 3-4 years ago, the one you see down here called Finalto. And then I started hunting myself, invested in a couple of companies. I missed out on Guru, but that's the way it is. And then I guess my main day-to-day occupation is running GCEX. It's a mixture between traditional broking and crypto. So one of the bad guys. But I actually have an FCA permission to do the crypto still until the FCA maybe not change their mind with compliance. Who knows? And in that capacity, I have actually just raised money. So I guess it's the kind of a blurred line between hunting and being hunted.
Excellent, thank you, folks. And so if we can start with the hunters, the acquisition side, in a crowded retail space where a lot of companies offer the same products, the same services, what are you essentially looking for from a combination of numbers, people, products? What do you look for in an acquisition? And let's start with Luca.
Yes, so absolutely right. I mean, there is like a market which is kind of saturated from a product perspective. Like we find many brokers that have very similar products. So is a little bit of a cliche, but we are very much data driven. So we look at quantitative data. And then also we look at the qualitative aspect. But the key point that we look in our target is really which market they focus, which license they have, and then we go in more qualitative aspect in terms of how they acquire the clients, which channels, what is of course we have some proprietary technology that we can evaluate the trading flow and give a price. So it's a very specific market. We came across some other private equity firm, more generic, that don't know the brokerage business, the leverage brokerage business so much, and they've been struggling just looking at the financial numbers, because obviously the way you take risk when you conduct this business is substantially different than any other business, and so really like it's very, from our perspective, it's impossible to just give a multiple or EBITDA or things like that. We really go much more in details, and yeah, it's really a combination of multiple factors. It has to be from a certain perspective, he has to be a strategic acquisition, and when we look at taking over a business or a client book.
Yeah, so I will divide the acquisition maybe to several parts. So first of all, it's 4 things that you're acquiring. First of all, it's the team, and the team needs to be complementary. It's meaning if you are usually the company which you're acquiring has a CEO and the founder, and has a DNA of the company. So when you're acquiring, it's like a living creature. So when you're acquiring, usually, from my experience, having 2 co-CEOs, okay, it's a better, because if they complete each other, let's say one is more CVO type, which is Chief Vision Officer, and the other is more a CEO type. So when you're acquiring, so this is a very important thing that we're looking at, that it will be a complementary company, okay? Now the second thing, it's a product, okay, how the product is complemented. So what Luca is saying is, what's the synergy of the product, okay? So the product, we have an existing clients, how can we upsell this product to our existing clients? The third thing, it's the clients. So how can we upsell now our product to their clients? And now the fourth thing, it's the financial engineering, because usually you're acquiring, you're trying to acquire lower than the market price, right? Because you are at a higher market price, otherwise it doesn't make any sense. Like especially for public traded companies, it's very important. So you're trying to create, in that, basically all these 4 components, creating a price, how much you're ready to say, to pay for this company. So it's a combination of the 4.
Brilliant. And so all 4 of you have gone through the negotiation process from different sides of the fence. In your experience, what mistakes can be, or positive steps can make or break a negotiation? Daniela.
So, mistakes. I've seen quite a few. One of the things, for example, on the seller side, they are so focused on what price they will get for their company that they may not pay attention to who the buyer is, so they don't do their own due diligence on who the buyer is. I'm coming from a background of CFD broker in Cyprus, so there's a characteristic to the M&As there, quite small in comparison to what's happening in London, but for example, if a seller agrees to sell the company to a buyer that hasn't proven their ability to pay for the transaction, or they are not fit and proper to be approved by the regulator, it can put the seller in a situation where they are locked in a transaction and they are not able to get out of it, especially if they also haven't been careful to the legal terms that were agreed to in the SPA. So they must do their due diligence on the buyer, make sure that they have the funds, make sure that they are fit and proper to be approved by the regulator, make sure they have clauses in their in their agreements to put strict deadlines as to what steps will be followed in the process, because otherwise if the process takes too long, then again, the deal can break, or the terms can worsen, and the more the time takes for the deal to be completed. And another probably mistake, again coming from the CFD brokers space, the usual scenario is that because there are some regulatory requirements and some approvals that need to be obtained prior to the completion of the transaction, usually the buyer will come in with a smaller stake, a minority stake, but in essence they will take control of the company to manage the company while the whole process is completed from the regulator's side. And the seller must ensure that during that process, during that time, the buyer will not be able to burn the license by incurring any reputational risks or by spending the money of the company recklessly, or taking any measures that could cause harm to the company in the meantime. So they could do that. So a positive step is by ensuring that they still maintain some control. For example, they keep some members on the board of directors so that they could still have some decision power. Or they could also keep control of the banks, for example, so that they can manage the financial transactions instead of giving full control to the buyer until they are fully approved by the regulator. In terms of the positive steps, do your due diligence, clear due diligence, make sure that your agreements are strong enough to protect your interests from both buyers and seller side. Yeah, this should be done from both parties. Have good advisors, but not too many, because too many consultants can actually cause problems in a deal. They can come with differing opinions that could pull you in different directions. Just take the good advisor. Definitely have legal advisors. Use escrow accounts to make sure that the funds are transferred at the right times when the steps are completed. So, yeah.
Excellent. Lots of sound, basic advice there with the escrow and things like that. And Lars, we haven't heard from you yet on what mistakes and positive steps can make sure that the negotiations go as smooth as possible.
Well, I guess ultimately you also need to trust each other to an extent. Of course, that was well spoken from compliance, of course, everything in writing. But ultimately, of course, we humans deal with humans. So don't want to go into my own transaction, but there's also be aware of something, cultural differences between buyer and seller. The extreme, of course, there's a lot of Asian buyers. I guess it's not a racist to call them. There's a lot of Chinese people trying to enter the FCA market. And I guess I have at least seen on a number of occasions some churn on the management level because they just want to put kind of other people to take the hit if something should go wrong, of course. You rarely see them on the register themselves, whether that's because they can't pass the fit and proper, I don't know. But yeah, of course, be careful. Look at, if they expect you to stay, can you see yourself working with them, whether it's a minority initially or I guess a lot of deals are also on an earnout basis. I don't know about, of course, Guru and the others, but most transactions are done with an earnout element, meaning that, you're essentially depending on that you can work with the new owners, because if they don't support you, then you'll never meet your earnout targets. So yeah, and don't be too aggressive on the deferred payment. I think that's also something we haven't touched on. The buyer will of course try to defer payments as much as possible. And make sure that you check out, what clauses they have for clawbacks, etc. I've never experienced any of the above, so I can only say that the buyers I have dealt with were super professional. And there was also mainly large institutions, but I have know firsthand that people that have been royally shafted on earnouts and clawbacks actually.
Luca?
I would echo what Lars and Daniela mentioned. I would add that, definitely it's about trust, it's about time. The longer it takes the negotiation, the usually you kind of lose the momentum on certain things, which is very much linked by losing the trust. So that's really important that the seller does the due diligence on the buyer, understand that they have a serious individual or group that really wants to make this deal happening, and there are some certain guarantee that this they have some experience and they're going to make it happen. The other thing is that on the seller side that we come across a lot of times with people that have, I would say, expectation that are a little bit outside of the market. So I think it's really important that it's fine to check, get a benchmark and so on, but and it's what is really important is like do not drag further, because in terms of like if I want to sell at some point at a certain price, they're not gonna get it at this stage. You need to. It's totally fine to go back and say, okay, I'm gonna take the company to another level, and then I will sell it, I don't know, in a year or so. But don't try to, negotiate too long, because really it just doesn't lead anywhere. It's just a waste of time for both parties. I would say other thing, it's important as well that between the seller and the buyer there is enough sharing of information. For example, we spend a lot of time to make sure that the seller or the potential seller understand how we price them, and so we try to make this as early as possible, and we saw that it's much better, because we don't want to draft a letter of intent and so on, and then a month after the due diligence we start renegotiating, making material changes, which could happen, because you never know before due diligence. But still, it's important that the seller get much closer to the buyer when they understand how we price companies like classic leverage CFD brokers.
So both to Luca and Andrey, I mean, there must be some investor friction. I mean, you said about a lot of the times they're CEOs, it's their baby, it's their DNA. I mean, how much friction do you get from from the investors, and how do you overcome that?
What do you mean by friction?
They can take it as a not take it in quite so positive light, that they don't understand where you're coming from, and so. I've been involved in situations where companies been involved in buyouts, and people say CEOs, they founded the company, it's their baby, and so sometimes there's friction. No, or is that not the case?
Yeah. So M&A, any M&A, it's like marriage, right? So it's either you're finishing your career, and that's it. We bought the company, go home, we take it from there. So. I haven't done this kind of deals. Mostly what I've been doing is mergers, okay, with a component of cash out, okay, which basically you're saying, okay, you've gone till here by yourself, well done, here's some cash. From here, we're going to build much bigger dream, because you need much bigger finance, you need an ecosystem. Today you need the ecosystems around you. It's not enough to be just go and raise, because you might be mistaken. You need another heads in the process. So I think when you're acquiring somebody, so from our perspective, when we're acquiring somebody as a hunter, we are selling. What do we sell? We sell a better life with us, because we will give you not just cash out right now. So you'll buy a nice house, I don't know, Ferrari, whatever you want. So you'll have a relaxed. You don't need $100 million in your account. You need basic things that will make your life happier, and you need something to do after the basically merging on acquisition and joining the greater ecosystem. Okay, a private equity or a group, and now you need to look at the following things. Okay, what is my salary? How can I grow inside the group? Okay, what my earnouts or deferred payments, and what is my legacy? Am I a co-founder in a bigger group or not a co-founder of a bigger group? So there are many elements of ego, and as a hunter, you need to manipulate, of course, these elements of ego so to reduce the price. But if it's like I'm always saying, if I'm your friend and I'm buying your company, probably I'm going to get a cheaper price, right? So build good relationship and promise him very good vibe from going forward. The better the vibe, the cheaper the price.
Yeah, no. for sure there is a human element, like they're emotionally attached. I mean, if somebody is a founder of a company, of course, the perception of the valuation, not only of the company but the value that they can add to the company, it's really most of the time what I see distorted. From an investor perspective, even when I was doing like more, not private equity, but kind of business angel investing or VC investing, having a one-man show is always a risk. Like having a person that really conduct the business and really like everything revolves around that person is a major risk. So when we look at it, I agree, like from our perspective, it's like, okay, this is a risk. It's going to be a discount in a way. It's not, we don't see an added value. Also there are consequences, because in some cases you have, if you go through with a deal, you have to make sure that this person remains. And most likely this person brought in the team that you actually are quite excited to have and you want to keep having them. So you have to make sure that you put in place the right incentives for the seller and the founder or the leader that can stay, but at the same time is not going to be on the steering wheel. So he has to be the passenger seat somehow, and he has to be there for some time. He has to be okay that we're going to take the company to, it's not just enough saying a bigger company or so on, but like we might be steering the company in another direction. We might be taking decision that goes against his belief or against what he thought he was right to do. So there's a lot of psychology you have to do there.
Yeah, I mean, I was lucky enough to interview yourself, Andrey, a while ago, and you spoke about how important the good vibes. And I can see it's very much your responsibility to ensure the good vibes are there. And so, okay, I understand that. Like, I mean, how do you, like the personal relationships, has there been occasions where there really hasn't been a personal relationship there, no matter how hard you tried, but you really want that company? How do you overcome that? Can you force the good vibes?
I don't want to be in a marriage when the other side doesn't want me. Let's start from that. So I never had, but I did, like a week ago, we closed the deal. We acquired a company in Chicago, and the negotiation was like 14 months. For 40 months, we negotiated. From the moment that we met, and I knocked on his door and said, I want to become a part of the Prytek group, because we're running in one of our operations, we manufacture and basically running the infrastructure for global universities for cybersecurity and IT education, and there's a company for doing managed services in their recruiting. So it's like a vertical for IT personnel, right? So we create IT personnel, and we want to place them. So that was my arm into. So it was very strategic for me. And the guy it's a terrific company, growing, amazing. So he's coming to me and saying, "Why would I sell? Like, what do you like?" Every week there's some private equities calling to me and asking to buy. I said, I don't want to sell. I'm generating a lot of profit. I don't need more cash than that. I will be bored. Whatever. Now I said, no. Second. You start a new life. You're going to start. I don't want to buy 100%. I want to buy a control stake, right? I want to buy 60, 70%. It doesn't matter. It's because we consolidate as a group. You still run the show, but you're going to enjoy a lot of cash availability. So you're going to become a king of the industry in the States. You can acquire others. Mm-hmm. So suddenly he can feel ego and power, so he can become a king. And you're going getting exposed to we have an internal corporate venture fund with like 50 companies inside, and those technology eventually they're going to reduce and there's a lot of HR tech technologies which are going to make your company not as a service company but as a tech company right now, because now, instead of running the process manually, you can run the process of technologies, which we basically, and he automatically bought a company after we acquired him. He acquired one of our companies, and that was the main reason why he did the deal. And this is exactly that. There's much more things besides money. Okay, money, it was just one component he got. He actually got so low money. He's like, in his eyes, it is still his company. It is still everything. He just got bigger, and with technologies. So you need the technology, otherwise you're a dead horse.
So, from the acquired side, Lars and Daniela, you've got Andrey and Luca knocking on your door, big bunch of flowers, trying to court you. You've gone through the courting process, you've decided, yep, let's do it. What shocks are there, and how do you manage those shocks in the integration?
I think it was mentioned quite a bit that we have to ensure that the employees will not, have a general exodus from the company once the news of the acquisition is out. So again, one important thing is confidentiality when it comes to these transactions. So until the negotiation process takes place and all the agreements are signed, it shouldn't be out. Employees shouldn't know, or only those that have to know, such as the financial controller and the accounting people, for example. But the rest should not know. So confidentiality is very important, because if the news comes out beforehand, it may scare people. It may make them think that things are going to change towards the worst for them, and they might start looking around. And also, it could increase the rumor in the industry that something's going on with this company because all these employees are leaving, and it's just like a snowball effect of negative events that can happen for the company. So confidentiality is very important. So I was reading recently about Spanx, that they were acquired, and I saw that they offered employees $10,000 and 2 tickets for traveling around the world for each employee of the company. So I saw that as an effort to keep the employees on board and prove to them that the company is solid, they maintain their vision, they will continue growing, they care about the stakeholders, and employees are a big part of the stakeholding group. So I think that such things must be put in place. Integration must be fought before the transaction is completed. So I think, again, one of the mistakes could be that a buyer and a seller focus so much on the terms of the agreements, on the price and everything, but they may forget that actually the hard work starts after the exchange of shares and cash. Actually, it's when you have to deal with the informing the employees, making sure they stay on, informing the other stakeholders, the clients, and so on. So yeah, this can be managed in different ways. Like I said, benefits to the employees. They don't necessarily have to be financial. I guess there could be, verbal messages, encouragements, communication. Definitely communication is key. So I think communicating to them what the bigger vision is, why this acquisition is important for the company, how it will help the company grow in the long term, and of course that will also give the employees the opportunity to grow with the company. So yeah, communication is definitely key for managing the shock of the acquisition.
Lars? When managing, say, the shock of acquisition, it's been agreed, you've accepted Luca's flowers and invitations for dinner, etc., weekend in Venice, and you're going for selling the company, the initial shock, how is it communicated, how is it kept from the employees, how do you maintain keeping things on track and making sure that the acquisition that's been agreed goes through?
I guess the acquirer, they buy you because they want business as usual and more of it, really. I guess in the short term, they don't come in to fundamentally change the business overnight. I guess some deals are done because you get a stronger balance sheet. I think it's also very important to the employees that you sell this as a positive. There's more career opportunities. Usually, you get acquired by someone that's bigger than you, with deeper pockets, more balance sheet. So you can sell the dream about group career opportunities, more geographical reach, opportunities for relocation, I've tried all of the above actually. So it's firsthand, and it works. And of course, the monetary component that some of the consideration is deferred. Also for the employees, where I've been, the employees have always been part of a warrant program or similar, and then you can see the value of hanging in there. But of course, if Luca came with some flowers and some money, then I guess you need to get along. And I will echo what someone said, that it needs to be fast. I admire that you had a process dragging on for 40 months, because having been through the process a few times, it's really stressful and time consuming, and it really distracts from the business, because as the owner and your baby, sometimes I at least feel a bit upset. Why do we have to go over this again? I don't know your process, of course, but if you talk to some of the bigger PEs, then you start with some analyst, then you have to repeat the whole story for the next guy. He's probably associate. I don't remember the hierarchy. And then on the third time, when you repeat exactly the same story and exactly the same number, you probably reach the partner level. And then it has to go to some sort of investment committee on the private equity side. So I think I see a lot of the models being a bit flawed. I respect what you said, Luca, that it's very modular. You have a model, it's quantitative, but for the CEO or the seller, it can be very stressful that you need to repeat. And I think that's at least something that will change, over time. I at least, when I'm selling again, and I actually just sold something a couple of weeks ago, I said, I'm not fucking doing this again. Actually, I'm not selling to a traditional PE because, I told you once, I don't need your money. So, of course, I can also be a bit more arrogant, I guess. But we both sides need to agree on the terms and the process. And I think speed is of essence, because if you lose momentum, if you put it aside, we'll come back to you in 3 months' time, or something like that. It's like any sales process. If we're all good salespeople, I guess. If the client tells you, we'll think about it, then it's dead. Then they'll just forget it, move on.
Yeah, I would just add that the confidentiality when you have a deal, it's key, and usually you have a mutual interest between the buyer and the seller, and you do that to protect the employees to take this uninformed decision, right? So this is like normal practice, and you do it the day the deal is disclosed, and the new owner or the new strategy, the new mission is communicated. The only way it works is that with that new vision or that new mission that you're going to establish, is that actually the employee buys into this mission in a way that they see how you can actually solve their problem. Because no matter how good your company is doing, if you talk to the employees, they will tell you what is the problem, what they're struggling with. And if you are just acquired a company, and that's why communication is important, to communicate what you're going to do, but you have to lead by example. So you actually have to show how in practice you're going to help them in the daily work they do. Only in that way they will buy in the mission.
And so, love to know, how often is the walk-away tactic used, and is it effective? Andrey.
Walk away. I
The
told
walk
you,
away.
it's only when it's aligned. I don't marry if somebody doesn't want me. There's no walk away. The reason, by the way, we had 14 months negotiation. I was ready to close the deal tomorrow. His company was growing 120% a year. So it was like, so I don't want to sell this price. So it's so every quarter. So after we signed the term sheet, we even changed some details. But actually, regarding the previous question, I just wanted to say something. We have a rule of 100 days after the deal is done. Okay, it's a best practice. It's not us invented. McKinsey, some long time ago wrote a huge article about it. Why the 100 days? It's because after the deal is done, like I agree with Luca, all the company need to understand there is a new company right now being born. Okay, we're becoming bigger part of something bigger, and so there is a new strategy, a new business plan, a new products coming in, new clients coming in, new people coming in. So all that, so there is a lot of division. Like HR need to be treated, marketing, positioning, like a new business plan need to be provided in 100 days, and the board need to accept this new. And that is basically, it's critical to do it in the first 100 days. If you don't do this in the first 100 days, it will never be done. It's like basically just continuing the old company which you acquired. So you want to give this fresh momentum, like something new was born at this moment. And coming back to your question, no, I don't want to do a deal. If you say I'm walking away, so walk away, go. Like there are alternatives here. It's fine. This is why I want to do a deal of one, and I'm focusing on one. You cannot. I can date several. Okay. At the same moment, but you always prefer somebody, okay? So if he's playing a game, it's a game, okay? Of walk away, it's a very non-mature game.
But does it happen?
No. I haven't seen I walk away. It's like okay, I'll go. Nothing happened.
I think we walk away for most of the deal, but just because we tell them where we stand. And if, as the market, there are others. So we're not willing to engage in a negotiation that goes on for weeks or months when there is a lot of option available. So we make an initial assessment. We see if there is a potential to do a deal. If not, it's more like, okay, this is our offer. We're not going to touch it more than that. And we just... In any case, most of the time, we have parallel deals goes on, so in different stages. So that's why it's important, the speed, because there are so many alternatives out there. And in some cases, we were interested in a company. They decided to go with another buyer. They experienced the problem of the change of control with people who were not, let's say, properly fit. And then several months later, they come back to us, but they were not interesting anymore for us, even at the same condition. So yeah, it's really momentum sometimes. But I don't think it's a technique or something to just walk away. You just put the boundaries and say, this is where we stand, and you explain the reason, and that's it.
Yeah, actually, very good point, because I also think you need to agree on the headlines of the commercials kind of within, the first two calls, I would say, or whenever, because if you negotiate back and forth, like in the Turkish bazaar or whatever, that's not going to work. You need to agree at least on the headlines kind of immediately, so you can then talk about the details, because if it drags too long, then both sides, they forgot why they actually wanted to do the deal in the first place. And again, this with the momentum, it's now that the buyer, he wants you, and it's now that you actually want to get out. We've all tried this with exponential growth, this 50% growth, and said, okay, next year. I remember at my previous company, we were growing, 200% a year, and we extrapolated that by 2020 we would be bigger than Goldman Sachs. It's actually true, but of course, it's not going to happen, is it? So don't extrapolate yourself out of the game. Even Facebook is in decline now. So, now I've gone from FX to crypto. We also see growth and valuation. I'm not sure that Guru would pay the Coinbase multiples as an example, because of course they haven't tried any setback yet. I think, again, I don't know the broker valuations these days, but people that have tried to live through SNB, On the 14th of January, there was a well-known American broker with 4 letters. They're down here. I guess, was it a $100 million company, you think? And the 15th of January, 9:30 or 9:31, I guess, in the morning, GMT, they were gone. There was another well-known Russian setup. I guess it was also worth a couple of $100 million on the 14th of January. And the following day, they were bankrupt. So I guess, at least from me, having been through, getting old, etc., having been through a few of these swan events, if you will, then sometimes I think, okay, yeah, let's take some money off the table and keep something on the earn-out or something like that. But you at least get some respect for things can change in a second. So, and having been through that, then you appreciate money in the hand more than probably not.
Anything to add on that? Have you experienced or done the walk-away tactic yourself, Daniela?
Actually, I haven't. So I can't say too much about it, but everything that my fellow panelists said makes sense. So yeah, I can't add to that.
Okay, brilliant. I mean, so before we wrap up, I want to get a bit of advice from you guys. I mean, it's been amazing insights. You've lived it. You're living it. From my own personal experience, when I worked for a company that bought the largest gambling affiliate site in the UK, they didn't do their due diligence, and somehow the URLs changed during the buying process, and it went from a £10 million website to a £4 million website within 2 months. So I've got my own experience. From your own experiences, what key bit of advice would you give? Start with Andrey. You're making eye contact with me.
To whom?
Yeah.
No, but to whom? Advice to whom? Basically to the seller?
From your own experiences, from
seller or buyer position?
From both.
From a buyer position, I said, I think sell your money. The more value you bring besides the money, the more expensive your money. Anybody who thinks that here in the buy side business, you're in the wrong business. It's not a buy side. It's a sell side business. You're just selling your money. You're selling, because money has worth, but Pablo Escobar money, okay, and Warren Buffett money worth different, right? It doesn't worth the same, although it's $1. So multiple your money by the value that you bring to the company which you're planning to buy. It's basically what kind of future you're offering to the founder, to those who are getting the money. And of course, to the people who are staying, because it's very important to think, otherwise it's a people's business. People gone, you don't have a business. You bought a black box, nothing, like clients, maybe products, but the key thing, keep the people and make them happy. From a seller position, always think about the next day, because what are you going to do the next 10 years? So you have a recurring entrepreneur who's going to go, okay, I finished with this, I'm going to build another one. But not everybody not necessarily wants to build. Maybe I want to stay in Amazon, who just acquired me, and build AWS and Amazon, okay, and continuing, become a CEO of Amazon. So there are different paths, and not necessarily need to repeat similar paths. So think about the next day and how this deal serves your next day, your wishes for the next day. That's it.
Luca?
Yeah, I would say make sure you know what you want and work toward that. I mean, at the end of the day, if you're on the sales, if you're trying to sell the business, it might not be the right time to do it now, and you want to do it at a higher valuation, or you need to ask yourself, okay, how do I need to get there? Maybe you need some capital in a different form. You don't need a full acquisition. Maybe you need some sort of other support. Technology nowadays is, everywhere. It's if you don't have it, you should seriously think about selling the business. But that's I would say my advice on the sales side. On the buy side, it's more like, of course, you have your strategy and you know what you want to do. But like when you individually look at each company, make sure that you go beyond and understand how can you really add value, not just with money, to this company? Like, how can you really make sure that the people, the valuable team that you're gonna take over can actually even perform better, and how you can solve their problem? That's what I would advise.
Lars?
Yeah, I also see that sellers or buyers, funds, they actually also just salespeople. You know, they of course try to convince me or the seller, okay, why this is a match made in heaven, how they can accelerate. So it's actually good advice with the trying to become your friend and then convince you that, okay, take a 20% discount because actually, you know, the pie will grow much faster. And, you know, sometimes you buy into it, sometimes you don't. But why would you? It's good to have a bigger partner, bigger balance sheet. I understand that from Guru, you only do full acquisitions, but minority also makes sense. What I've tried at least to immediately accelerate your balance sheet. I think there's quite a lot of money out there to be had, but you know, taking again, and this is not racist, but taking Chinese money when they can't be approved by the FCA at the end of the day, and then you wasted your time, or Escobar money, probably even worse. So I guess you need to be careful who you go to bed with, but you know, the needs to feel right for both sides, and I've had experiences where it felt really good and where it didn't feel so good. So maybe we can reconvene in 2 to 3 years' time, and I'll give you a bit more first-hand experience.
And Daniela, ending on a bang, your advice?
I think I can make a conclusion to all the advice we've shared here. So build a trust relationship, and it applies to both buyer and seller. So build a trust relationship, do your due diligence, make sure that the legal terms protect your interest, and make sure you think about the future, think about the integration, think about how this will play out in the long term and how it will be beneficial to both parties and the stakeholders.
Brilliant. Thank you so much, folks. Been a real pleasure. Really appreciate the time, the insights, and thank you for everybody at FMLS.